Hello and welcome. My name is Jeffrey Kennedy. I'm the editor of Futures, Junctures, and welcome to this video. This video is titled The Kennedy Channeling Technique, and this is a trendline technique I actually developed a number of years ago, at this point probably about 10 years ago. And the technique, the importance of the technique is that it actually helps me identify and classify Elliott waves in a more confident manner. And this is simply a trendline technique, but it's very effective, and I've actually been utilizing it for quite a while, again, the last 10 years. And if you're a subscriber to Futures Junctures or the monthly Futures Junctures newsletter, on occasion I'll mention terms like corrective price channel or base channel. These are all terms or all components of the Kennedy channeling technique. So I'm going to walk you through exactly the essence of what it is, how I use it. We're going to look at a few price charts where I actually apply the technique. And then after that, I want to talk about one or two additional things that I think are important with respect to being able to identify an Elliott wave pattern or Elliott waves properly and with more confidence. So that's what we're going to be talking about in today's video. Now, the first thing we need to basically work with or talk about is number one, corrective price channel or corrective price action. Okay, corrective price action. When I say corrective price action, I'm talking about your corrective wave patterns, your zigzags, your flats, your triangles. Corrective price action tends to be contained within parallel lines, and that I call that move, that channel, the corrective price channel. So let's say, for example, this is a three-wave price move, and we'll call this a zigzag, and we'll just assume this is 5 waves. That's our 3-wave move, and here we have another 5-wave decline. This is a zigzag. Now, how we would actually draw that corrective price channel is from the origin of wave A, draw a trend line to the extreme of wave B, and then drop that trend line or make a parallel of that line off the extreme of wave A. Okay, this is the corrective price channel. Now, what I tend to find with respect to the corrective price channel is you tend to see prices move down in wave C, but find support at or near the lower boundary line of the corrective price channel. This is essentially what I work with whenever I'm working with counter trend price moves. Now, if on occasion, whenever I see a 3-wave price move, a zigzag, sometimes you'll see maybe a variation of that move, and you'll see something along these lines here. And let me go ahead and slide this over, find some free space, and you'll see a price move that looks maybe like this. Okay? And what will happen, again, with the parallel lines, origin of A, extreme of wave B, down to the extreme of wave A here. So this would be, well, let me go ahead and put that in so there's no confusion. This would be my wave A, and then this would be my wave B, and then this would be my wave C. Sometimes I see wave C end here, around the center line of the corrective price channel. Now, the reason I'm making this distinction is because here I call this a bottom line reversal, because this is the bottom line, or the bottom line of the corrective price channel. This is a bottom line reversal, and this is what I call a center line reversal. Now, the reason I'm explaining this is because it has a bit of an importance with respect to actually not simply being able to identify a corrective price move or a counter trend price move in a particular market, but it also has a trading application. And what I'm referring to is typically if I see a center line reversal, then price action, which is bullish or impulsive, above the midpoint of the price channel is usually an indication or a green light for me to begin looking for a trading opportunity. In this instance over here, when you have a center line reversal, or where wave C ends at or near the midpoint or the midline of that corrective price channel, then it's going to take daily closing price action or some type of strong impulsive closing price action above the upper boundary line here to signal that wave C is indeed done and that we're going to be basically retracing the entire move. So again, this is the type of thing I want to see to kind of give me a green light to begin looking for trading opportunities on a center line reversal price chart, or here if we have a bottom reversal. Now, if the market is upside down, and what I mean by upside down, this is a counter trend move. So that means the larger trend is bullish. Okay, if the larger trend was bearish, then this would essentially be a 3-wave advance. So keep that in mind as we look at these price charts. Now, some of you might be who are very familiar with Elliott might be going, well, what about, say, the flat corrections, the expanded flat corrections? Because an expanded flat correction it forms whenever you have, say, three waves in wave A. Okay, we are doing the expanded flat. How do you draw your corrective price channel when you have this kind of form? Excuse me. When you have this kind of a pattern working in a market? Because if we do your corrective price channel the way you've outlined it, Jeff, then you actually have this kind of a structure, and that doesn't work. What do? Okay, with flat corrections, okay, and a flat correction, no, Elliottians using the notation 335. And that basically, what I mean when I say 335, very simply, wave A subdivides into three waves, wave B subdivides into three waves, and then you have a five-wave move for wave C. So there's my 335. With a flat correction or an expanded flat correction, you draw your corrective price channel, again, from the origin of wave A to the extreme of wave 4 of C. Because within wave C, again, wave C is going to subdivide into five smaller waves. There's waves 1, here's waves 2, 3, 4, and of course 5. And let me fix that up. There we go. So, with a straight zigzag, and let's kind of slide a chart over. Again, this is a zigzag, and let me clean it up a little bit. What we'll do here, or how we draw that corrective price channel, and again, let me reiterate this, from the origin of wave A, you draw a trend line to the extreme of wave B. Connect the tops. Take a parallel line of this line here, drop it down to the extreme of wave A. And there, what that will do is, number one, it defines this price action as a counter-trend price move and also identifies support for wave C. There's two areas to look for support, the center line or the lower boundary line. With a flat correction or an expanded flat correction, you draw the initial point is going to be the origin of wave A to the extreme of wave 4 of C, which is over here. Draw this trend line, take a parallel of that line and drop it down to the extreme of wave A, and in this instance here, looks like a center line reversal. That's how I draw the corrective price channel. Now, again, I've been working with this technique for a little over 10 years now, and I found it extremely valuable and very reliable with a very simple concept. Counter-trend price action, corrective wave patterns tend to be contained within parallel lines. Even if we're just thinking that, okay, what about a triangle? Well, that's almost the epitome of a price action contained within parallel lines. There. We just simply go sideways in that type of a pattern. Okay, but if we basically embrace one idea, one idea here is that counter-trend price action, corrective wave patterns are contained within parallel lines. So if price action begins to move out of parallel lines, then it's no longer corrective. It's no longer a counter-trend price move. It's an impulsive price move. And this is, again, the essence of the Kennedy channeling technique. So let's look at a five-wave structure. We've been looking at corrective wave patterns. Let's look at impulsive wave patterns. Here's our five-wave move. Waves 1, 2, 3, 4, 5. Notice that all the rules and guidelines are adhered to. Wave 2 does not end below the origin of wave 1. Wave 4 does not end in the price territory of wave 1. Wave 3 is not the shortest impulse wave of waves 1, 3, and 5. This is a classic Elliott wave impulse move. Okay, well, the first thing that we do is draw the base channel. And the base channel, of course, is going to be the origin of wave 1 against the extreme of wave 2 against the extreme of wave 1. That's your base channel. Okay, very important. This base channel is it's critically important, okay? And it's critically important for two things. Because really, up until that point, let me just slide that over. You have the move up, the move down. Up till this point, really the best way, the most confident way to interpret that price action is simply A, B, C, because there's no price action, no price evidence to the contrary. It's when prices begin moving above that line right here where you can begin to think to yourself, hey, that's third wave price action. We've taken out the upper boundary line of the base channel. Therefore, we have actual chart evidence, price action we can point to with a pen or a pencil and say, this is happening. This supports the conclusion that this is indeed a third wave price move. So here we have our base channel. Again, from the origin of 1 to the extreme of wave 2, draw a parallel of this line and take it to the extreme of wave 1 and extend it across. When this event happens, then you can confidently begin to look at this move as a 3. Okay? So then we come to what I call the acceleration channel. Here's the acceleration channel right here. It's simply from the extreme of wave 1 to the extreme of wave 3 off of 2. Okay, now what this essentially does is it basically identifies the boundaries of wave 3, and also too lets me know when wave 3 is complete and wave 4 is beginning. Because as long as prices are within this price channel to the upside, wave 3 is still very much in progress. We have to break out of that lower boundary line here to signal wave 3 done and wave 4 underway. Okay, well, how do you draw that? How do you know that is indeed the case? Well, let's just go ahead and draw the acceleration channel here. Okay, let's pretend, for example, maybe this price action hasn't happened yet. Well, I simply draw from that point, drop it down. Okay, at some point, I'm not going to be able to adjust that acceleration channel anymore, and it's going to become fixed. So at some point, I'm just drawing it and adjusting it for price action, adjusting it for price action, adjusting it for price action, moving it up, and finally at some point it's going to stop moving higher, at which point I'll simply drop it down to the most extreme low, and then just watch and wait. Once this happens, once we take out that lower boundary line of the acceleration channel, then what we have at that point is confirmation, again, chart evidence to argue that wave 3 is complete and wave 4 is underway. Which brings us back to the base channel. One of the things so important about the base channel is that it provides support for wave 4. What you'll find with that fourth wave move to the downside is that it tends to find support on one of these trend lines which actually make up the base channel. So again, that's why I like the base channel and tend to keep that base channel on the price chart, is because number one, penetration of the upper boundary line of a base channel in a bull market signals or confirms the presence of third wave price action. Those trend lines which make up that base channel actually provide support for the fourth wave pullback. Now here we simply draw our 3 lines here. This is what I call a deceleration channel, or what we initially examined to be the corrective price channel. And once we begin taking out the upper boundary line here, again, here's our confirmation. But as I said a moment ago, because of this structure right here, this is actually a center line reversal. So we could actually begin thinking about taking a trade to the buy side once we get prices. This is a lower boundary line reversal. Once prices begin moving above the center line of the corrective price channel, then at that point, we can begin thinking about taking some trades to the upside here. Very simple technique with respect to trend lines, but it can add great confidence with respect to your Elliott wave interpretation. Number one, being able to identify a price move as either impulsive or corrective, very important first step. And then as the price action is unfolding real time, it gives you a guide to kind of help you stay between the lines here. And then of course, once you have broken out of the upper boundary line of the deceleration channel, signaling or confirming that wave 4 is indeed done and wave 5 is underway, then at that point you can just simply go back to the book and utilize R.N. Elliott's standard Elliott terminating channel, where you simply draw a trend line from the extreme of wave 2 to 4, take a parallel of that line off of wave 3, and that will tend to show you some resistance levels or an area for your 5th wave move up. So that's essentially the Kennedy channeling technique. The core of it is the idea that counter-trend price action corrective wave patterns tend to be contained by parallel lines. Well, if that is indeed the case, then price action which is not contained by parallel lines is impulsive by nature. The way I kind of like to phrase it sometimes is 3 waves, 1 channel, 5 waves, 3 channels. The base channel, the acceleration channel, and the deceleration channel. So this is, and again, in essence, this is the principle and the concepts behind the Kennedy channeling technique. Now, let's look at some real-time price charts, and I'll just show you a few things that I'm looking at and how I actually apply the Kennedy channeling technique real-time. Okay, here's a stock. This is a DECK, and let's just take a look at it, and I'll tell you what I see initially. Well, the one thing that I see here, of course, beginning over here in late August of 2011, is the move to the downside here. Notice this, nice move to the downside. Here's 3 waves, okay? That's a 3-wave counter trend move, and I can just tell by the look of it, without even doing it, it is indeed contained by parallel lines, just like what I've been talking about. Looks to be kind of a center line reversal as well. Okay, what really catches my eye about this price chart is this up, down, down sequence. Notice the overlapping waves here. This to me looks like an ending diagonal. Okay, and for those of you who are familiar with Elliott or the Elliott wave principle, know that an ending diagonal is a terminating wave found only in the 5th wave position of impulse waves, or the ABC position, as wave C of an ABC structure. But this looks to me to be like an ending diagonal here, most likely a 5th wave. And now the subsequent price action is very interesting. We have a big move to the downside here, price gap in the middle. That screams to me, or argues very nicely, hey, I'm a 3rd wave move to the downside. But again, we're here to actually apply these trend line, these price channels, to see how it works out. Well, let's begin with the high here. There's my, number one, we're working with the idea that this is a 3rd wave. That means this is my wave 1. This is the origin of wave 1. That's the extreme of wave 2. Okay. So what we have in this instance here, and let me go ahead and label the price chart. Here's 1, 2, 3, and what I believe to be still a 4th wave. Okay, but you'll go, well, first of all, number 1, let's walk through this slowly. Okay, here's my waves 1 and 2. I take a trend line from the origin of 1 to the extreme of 2, and a parallel of that off the extreme of wave 1. Drop it down. Okay, when prices begin moving below this line here, that tells me this is an impulsive decline, that we're indeed in a 3rd wave move. Because if it was a C wave, we'd still be contained within that price channel. We're not. Okay, now over here, we have pushed above the upper boundary line of the base channel. Okay, that's technically not all that good, but first of all, look too at the deceleration channel. We're still very much stuck in a counter trend price move. Okay, that advance we've seen in this issue is still contained very much by parallel lines. So I'm going to give the benefit of the doubt here to the overall slope and structure of this, because the move up off the low, A, B, looks like a little bit of a C to me. Now what I'll be looking for next, again, erase all our work, all our trend lines. And then the next trend line we're going to take is, of course, the standard Elliott channel here. So I'll be looking for prices to either fall down to this trend line or possibly even be a bit lower here in wave 5. But again, the channels also tell me that wave 4 is still very much in play. Okay? Because what I'm going to be looking at, number 1, is since we've already pushed so high here, this is most likely going to be a top line reversal, where either we've already have the top in place, or we're going to pop higher and then come down. Well, if you remember what I was explaining with respect to the corrective price channel, if it's a top line reversal in this instance, we got to get below the center line here of the corrective price channel to argue that the correction is complete, and I can begin to entertain ideas about taking a short trade in this instance. That's how I apply it. Very simple. And it allows me to confidently, again, identify Elliott waves and classify Elliott wave patterns. In this instance here, I'm identifying this as an impulse move to the downside. Waves 1, 2, 3. This is probably a 4, so I'm looking down in wave 5. And also, too, it's allowing me to identify this as an impulsive structure. As you know, there's 2 types of impulsive structures, or 2 types of motive waves. Impulse waves and ending diagonals. 3 types of corrective waves: zigzags, flats, and triangles. Okay, let's look at another structure here. This will be a 30-minute price chart of cocoa. Okay, well, what we have here initially, well, there's my initial base channel. Notice the penetration of the upper boundary line of the base channel, signaling the presence of third wave price action. Okay, now what we simply do is we come in and draw our acceleration channel. Boom, right there. Notice the break here. That signals that wave 3 is indeed done and that wave 4 is underway. Okay, we didn't come all the way back down to the upper boundary line of the base channel here for support. But let's go ahead and draw this channel here. Very small, very sharp deceleration channel. Penetration of the upper boundary line of that channel right here signals that wave 4 is complete and that you're working the fifth wave move to the upside. And you can see the substructure of the fifth wave move very clearly. Again, very simple. 5 waves, say wave 1, excuse me, let me erase that, come back. Wave 1, wave 2, wave 3, wave 4, and wave 5. Again, very simple structure, but again, the reason I like the trend lines, the reason I like the Kennedy channeling technique, it allows me to more confidently identify these structures as either impulsive or corrective. Let's look at another situation here. This is a price chart of gold. Okay, this is 120 minutes. Well, the first thing I see here when I look at this price chart is from this extreme. Well, number one, well, hey, look what we've got. I don't even need to worry about really getting into the subdivisions here, but this is slow, choppy price action contained within parallel lines. Okay? Very, very simply. So these two trend lines, or these two little lines here, and the fact that price action is contained by these two little lines tells me confidently, again, because all this is about helping me be more confident in my Elliott wave and labeling or in my Elliott wave interpretation. This whole price move here, this is a counter trend price move. This tells me that the larger trend is up, and as a trader, I want to be playing the buy side. Very simply. Now also too, let's go ahead and we'll drop, this is a 120-minute price chart. We've already identified this as a counter trend move. Most likely looks like the structure probably terminated over here. Let's call this, say, 3 down for, say, a W, 3 up for an X, and another 3 down for a Y. But let's break it down to, say, maybe a 30-minute level here and look at the short-term substructure, well, 45 minutes, because I really want to take a look at the developing advance primarily. And again, apply our trend lines here. Where are we within the development of this 5-wave move? Would it be okay I mean, if we apply the rules and guidelines of the wave principle and start with our wave count here, could we do this? Waves 1, 2, 3, 4, 5. There is a top. Absolutely. But is that interpretation actually supported by our Kennedy channeling technique? I don't believe so. Why? Well, let's first of all take this approach. Okay? Well, we're just starting to get above this line right here. Nothing really stellar or that groundbreaking at that point, but that's when we need to drop it down a degree here and realize that this is most likely a developing third wave, so we need to adjust our channel a bit to really denote the third wave structure here. Okay, there we go. That's a little bit more like it here. And let me clean this up. There we go. Okay, now this is nice price action. Notice the price action above that upper boundary line. This kind of stuff happens when you're in an impulsive move. This kind of stuff happens when you're working a third wave. Okay, so within this structure, the way I would actually label it, and the trend lines are helping me now see this a bit more clearly, is that we most likely in gold now have, say, waves 1, 2. This is most likely, say, 1, 2 of 3. Probably a 3 of 3, 4 of 3, 5 of 3. So in this instance here, we look for a pullback, maybe a little bit lower, and then actually higher prices here. And again, one of the things that actually helps me come to that conclusion is, again, the trend line technique, the Kennedy channeling technique. Remember, 3 waves, 1 channel. 5 waves, 3 channels. 3 waves, corrective price action, counter trend price action, 1 channel. 5 waves, impulsive price action, trending price action, 3 channels. Let's look at another example here. And here I'm going to try and utilize this a little bit more real time. Okay, and just kind of slide the chart over as price action seems to fit. This is the transports, and we'll go ahead and do a little rescale here. And I'm beginning with this. This is June of actually, I believe, 2011. So what we have here is a little bit of a, from this extreme, 1, 2, maybe a 3 here, small pullback, 4, pop up and 5, extended 5th wave. Okay, I'm going to work with the idea that this is an extreme here in the market. And it is because it happened in 2011, so I already know. But bottom line, we have this initial move to the downside and the subsequent advance. Okay? Okay, now we actually start falling. Let me expand this chart a little bit here. Okay? So let's go. At this point, I have a down up sequence. Okay? I've got 3 points. With 3 points, I can draw my channel. I can draw my first channel. At this point, just like that. Okay, now what's the wave count in this market? Is it A, B, C? In which case, I'm actually going to be looking higher and viewing this price action as a counter trend move. Or am I going to be looking at this price action and go, okay, hey, this is waves 1, 2, and what I've actually got is a wave 3 decline unfolding, in which case I'm going to be looking for selling opportunities or shorting opportunities. Well, bottom line, we have to go back to the price chart. And again, I encourage you to employ the Kennedy channeling technique. Okay, with confidence, we really can't say either way what this is, except that this move to the downside is contained within parallel lines. So the most appropriate labeling at this juncture, very simply, is that this is an ABC decline. It's an ABC decline, very simply, until proven otherwise. Okay? Because what we're striving for is confidence and certainty in our labeling skills. So right now, because the move to the downside is indeed contained within parallel lines, we will call this an ABC structure until we have a reason not to. Well, as you can see, here came our reason not to. What we actually have is a decisive break of the lower boundary line of the corrective price channel, which means that we can now look at this confidently as, hey, this is an unfolding impulse wave. In which case, we simply go waves 1, wave 2, and this is actually a third wave move to the downside. Okay? Follow it a little bit lower. As you can see, the transports do indeed unfold in wave 3 fashion. Okay? Now at this point, we're going to be focusing on say our acceleration channel. Well, look what happened here. Well, let's go ahead. Well, number 1, let's look at the acceleration channel. We have a small break here. That could be our 4th wave, okay? Because again, we're going from the extreme of wave 1 to the extreme of wave 3 off the extreme of wave 2. This could be our 4th wave, but let's maybe expand the line a little bit to something like that. Yeah, it's still very much our 4th wave. Okay, so what I'll go ahead and do at this juncture is go ahead and identify this move here, very simply. And let me get caught up real quick, is wave 3. And again, the tools, or the technique allows me to be able to do this, again, with a bit more confidence. Okay? Well, compress the chart. Okay. Looks like we had a expanded flat or some kind of flat structure here for our 4th wave. Go ahead and apply the overall line because, again, our base channel is our most important line here. Notice our 4th wave right here. This was wave 3, or you could either put wave 3 here or wave 3 here. Subsequent move to the upside found, in this instance, resistance at the base channel lines. And then what we have here to have going to the low here is an ending diagonal. And again, we also employ our Elliott terminating channel here to identify our support Yeah. Well, we didn't really find too much of a support off that Elliott channel. But again, what's important about this structure in this example here is, number one, early in the move over here, we were able to identify that, hey, this move to the downside is not a wave 3. Not a wave C. We saw at this point on that price bar right here that this was a third wave move to the downside, that this was an impulsive decline, and that we had much, much farther to go. When price action started to advance to the upside here, or even here, or even here, again, we saw the importance of the base channel. It provided resistance for that fourth wave structure. And then once we cleaned out these lows here on the subsequent move to the downside, we knew this was our fifth wave. Bottom line, this move to the downside was not contained within a parallel lines. Thus, this is an impulsive decline. And I believe the Kennedy channeling technique in this instance allowed me to actually maneuver through these substructures, or maneuver through the substructure a little bit more confidently, with being able to identify waves 1, 2, 3, 4, look for resistance for wave 4, look for confirmation of wave 3, and then finally our fifth wave move to the downside. Now, subsequent price action in the transports, well, as you can see so far, what we actually have experienced is a nice big move to the upside, but the move to the upside is still contained within parallel lines. And we've also penetrated the lower boundary line of what I would call a corrective price channel. So it's going to be very interesting. This is still the first quarter of 2012, but the way it's looking, again, based off the Kennedy channeling technique here, is that we have an impulsive decline off the 2011 top here, and a three-wave move to the upside. So kind of like in the downside, if we move into March, April, May, we'll have to see about that. But again, this is a daily price chart. I'll be looking at the shorter term time frames, and again, applying this technique to see what it does appear to be unfolding. Okay, I'm getting a little bit long in time here, but I do want to also show you a few other things that help me identify wave structure a bit more clearly. Things that I've learned along the way, or that I do, that actually help me with increased confidence in my wave counting ability and skill. Now, one tool that's very important is your watch or a clock. How is this important? How can a clock help me identify Elliott wave patterns better? Well, when I'm talking about Elliott wave patterns, primarily the first thing you should think of initially is either impulse wave or motive wave and then corrective wave. And again, as I've already said, there's two types of motive waves, impulse waves and ending diagonals. With respect to corrective wave patterns, there's primarily three: flats, zigzags, and triangles. Okay, now how can this clock help me discern the difference? Very simply, slope. Slope is very important when it comes to identifying waves. Now, this is just something I've observed over the years. It's a very simple tool, simple technique, but really it does help me identify structure so much better. Okay, here's my clock. If a price move has an advance and the slope of that advance is between 12 o'clock and 1:30, odds are that's an impulsive move, i.e. the substructure is 5 waves. Now, if I have a move and the slope of that move is anywhere between 1:30 and 4:30, odds favor that that move is actually a corrective wave or a counter trend price move. Let me clean these lines up. Very simply, if you have an impulsive move up, a 5-wave advance in a market, and the slope of that advance is between what you would find between 12 o'clock and 1:30, that odds are that's a 5-wave move, that's an impulsive move, and that is a trend defining move. If you're looking at a price move and the angle or slope of that move either to the upside or to the downside falls between 1:30 and 4:30, odds are that that is a counter trend move, a corrective move, a price move. Because again, going back to the book, going back to the wave principle, what is the personality of a price move? What happens when an impulsive move is taking place? Prices travel far in a short period of time, i.e. the slope of that move is going to be high. Corrective price actions, flats, zigzags, combinations, triangles, They're choppy, they're sloppy. It takes a long time to travel a very, very short distance. And this is a very simple technique which actually takes into account the importance of slope with respect to identifying your Elliott wave structures. So let's look at, and just to kind of wrap things up here, let me just show you two more quick slides and we'll call it a day. Here we have two impulse waves, okay? We have waves 1, 2, 3, 4, 5. Wave 2 does not end below the origin of wave 1. Wave 3 is not the shortest impulse wave of waves 1, 3, and 5. Wave 4 does not end in the price territory of wave 1. Okay? This move over to the left that you see right here, we have 5 waves up, non-overlapping. All the rules and guidelines, the wave principle, are adhered to. Okay? Now let's look at the structure over to the right. Okay? We have waves 1, 2, 3, 4, 5. Wave 3 is the shortest impulse wave of waves 1, 3, and 5. Wave 2 does not fall below the origin of wave 1. Wave 4 does not end in the price territory of wave 1. In other words, this move over here on the right also follows and adheres to all the rules and guidelines of the wave principle. Okay, but what's missing? The slope. Notice the angle of this move. This is certainly between 130 and 430. This is not an impulse wave. I don't care if it follows the rules and guidelines appropriately. Trust me, this is not an impulse wave. This is an impulse wave. That's textbook. That's what you want to see. If this is the type of a structure, because of its slope, that it's most likely, say, A, B, C, X, or some type of corrective combination, but that is, or maybe even a series of 1s and 2s. But it's not an impulse wave, okay? Again, when it comes to being able to identify structures completely, Elliott wave patterns, and do so confidently, I rely on the Kennedy channeling technique and have for years. What I do with respect to slope, very, very important. Again, 12 o'clock to 1:30, that's an impulsive slope, okay? From 4:30 to 6, that's an impulsive slope to the downside. If price action is moving sideways between a 1:30 and 4:30, odds are that that's going to actually be a corrective move. When it comes to identifying wave patterns properly and correctly, 3 things I look for: subdivisions, personality, and slope. For example, in this instance over here to the left, it has the proper subdivisions. The personality, it's an impulse wave. Prices should travel far in a short period of time. They do. And with respect to slope, very apparent here. Keep this in mind next time you're labeling your own price charts. That about does it. Thank you so much, and I hope you guys have a wonderful evening.